We welcome you to our classes conducted by our YouTube channel SL Account School. Today's topic is Goodwill. Goodwill is the difference between the value of a business as a whole and the aggregate of their values of its separable net assets. This over and above value is received for various positive factors that particular business has, which is summarized as goodwill. Goodwill is measured as the excess of the cost of acquisition over the acquirer's buyer's fair value of assets, liabilities, and contingent liabilities acquired. In accounting, goodwill is an intangible asset. The concept of goodwill comes into play when a company looking to acquire another company is willing to pay a price premium over the fair market value of the company's net assets. These are few different definitions of goodwill. Valuing goodwill is unscientific and it's only arbitrary. There are few methods calculating goodwill. Average profit method is goodwill's value in this method is considered by multiplying the average future profit by a certain number of years. This can be simple average or weighted average. Next is super profits method. Super profit is extra profit that is made by the business than the market norm. In another word, making profit better than the market average profit made by other similar institutions. Next is capitalization method, where normal profit or super profits are capitalized. In the context of partnership, when there is a change, there can be an unfairness to the existing partners due to all unrecorded assets, including goodwill. Therefore, goodwill adjustment is necessary. Method 1, where a goodwill is recorded in full, crediting all partners as per their ratios, so any changes will not create any unfairness to them. In the second method, where goodwill remains unrecorded, partners who sacrifices should be compensated by those who gain. This may be settled as a private transaction by paying cash between the parties. No partnership accounts will be involved. If the visibility of goodwill is not desired, it can be credited on the old ratio and debited by new ratio into partner's account. The things that we spoke in abstracts, we can do practically by the following illustrations. Illustration 1. X and Y are partners sharing profit and losses into the ratio of 3:2. They admit Z into partnership for 1/4 of share in goodwill. Z brings in his share of capital in cash. Goodwill for this purpose is to be calculated at 2 years purchase of average normal profit of the past 3 years. We are required to calculate the value of goodwill and also 1/4 share of Z. 3 years profits are given, but you will note there are some non-recurring profits as well as is shown. In 2016, there is an abnormal profit by sale of assets, 5,000, which is to be removed. Loss made in 2017 is 20, which include a loss by fire, which is a non-recurring event that is to be adjusted. In 2018, into the profit, insurance claim and interest and dividend received is included, that to be eliminated. And it gives a clean net profit of 99,000 for 3 years divided by 3 gives the average of 33. 2 years purchase means multiplying that by 2, which is 66,000. 1/4 share of Z is 16,500 is the answer. Okay, the next MCQ. The total capital employed in the company is 800,000. A reasonable rate of return is 15% and the profit of the year is 1.2 million. The value of the goodwill of the company as per the capitalization method will be, 4 options are given, working is given below. 15% of 1.2 million is 8 million. The present value of the asset is 800. When you deduct that, there is 7,200 excess asset capitalized, which is the answer, C. The next illustration, A, C and D are partners in a firm sharing profits and losses into the ratio of 3:2:1. They decided to take J into partnership from 1st January for 1/5 share in the future profits. For this purpose, goodwill is to be valued at 2 times of the average annual profits of previous 4 years, which are given here. Total profit divided by number of years will give the average profit. Average profit into number of year purchase will give you the goodwill value, which is 151,700. Illustration is on weighted average profit. Each of each year's profit is given alongside. In 2011, profit 43,000, weight is 1 multiplied 43,000. In 2012, the profit is 50,000, weight is 2 multiplied 100,000. In the same way, total weighted profit is 984,400, weights are 15, divided by 15 is 65,600. 2 years of purchase gives 131,200. Next illustration is on super profit method. As you all know, super profit is the extra profit made by the business than the market norm. In this sum, the market norm is given as a fair return on capital having agreed to the risk involved is 10%. If you look at this solution, average profit is 40,000. Normal profit in the marketplace is 12,000. So the extra profit you make is 28,000. 3 years of purchase will give you 84,000 on the super profit method. Next is on capitalization method. A earns a profit of 120,000 as annual profit. The normal market profit is 10%. Therefore, the capital needed to yield this amount is estimated to be 1.2 million. The actual capital employed is shown here as 960,000. Therefore, the difference between them is goodwill, which is 240,000. Okay, the next illustration. A and B are partners in a firm. They admit C into their firm. The goodwill for the purpose is to be calculated 2 years purchase of average normal profit, which are given here. They are also given additional notes, second year's profit including profit on sale of machinery 10,000. As you all know, we have to eliminate that non-recurring events. Therefore, the second year's adjusted profit would be 15 minus 10, 5. Total profit 45, average profit 15, 2 years purchase 30,000 is goodwill. Okay, in the following illustration, A having the asset of 1 million and liabilities of 420, the firm earns an annual profit of 90,000. The rate of return is estimated to be 15%. Calculate the amount by capitalization of super profit method. Capital employed is 1 million minus 420, 580,000. With the 15% capitalization, the standard profit they could have made is 87,000 but the profit made is 90,000. The difference is 3,000. If it is capitalized at the percentage of 15,000, it will give you a goodwill of 20,000. The answer, the last illustration. A and B were in partnership sharing a profit in a ratio of 2:1, decided to admit C for a fourth of profit, require him to introduce 30,000 as capital and 6,000 as his share of unrecorded goodwill. You are required to show the necessary adjustment for goodwill on the understanding that no goodwill account is to be raised in the book. Answer is one journal entry, debiting cash with 36,000, that is 30,000 of C's capital plus 6,000 of his share of goodwill, credited to C 30,000, A 4,000, B 2,000. Dear students, we recommend more and more exercise like this in order to get a clear understanding of the subject. Dear students, as you all know, these classes are provided to you by our YouTube channel, SL Account School. We kindly request you to subscribe, share, like, and promote it among those who are interested. Thank you very much.